Hello and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. By now you'll know we're both tax partners in RSM's London office, and between us we have a wealth of experience in dealing with a wide range of private client matters. As ever, your feedback is valuable to us and we do use it to consider what we'll talk about in the next session, so please keep it coming. We can be contacted at rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com.
So, Rachel, I've been getting lots of questions over the last few months about whether people who hold rental properties personally should transfer those properties into a company. And that means I have a question for you in turn, which is, firstly, why are people asking me this? And secondly, is it a good idea?
Well, the answer to the first part is easy. People are asking as there has been a lot of commentary in the press which indicates that holding rental property through a company is more tax efficient than holding it personally. And that's simply because a company pays tax at 19%, whereas if you hold the property personally, you're going to pay income tax at whatever your marginal rate is, whether that be 20%, 40% or 45%, but whatever the rate, it's higher than 19%. But more importantly, there are changes in how finance charges are dealt with. So historically, the finance charges, by which we just really mean generally it's the interest on the mortgage that you've acquired to buy the property, was deducted directly from the rental income. Nowadays, it isn't. It is now what we call, it's a horrible term this, a tax reducer. In other words, finance charges are not deductible from the rental income. So instead you calculate your tax liability ignoring your finance charges, and then you reduce the resultant tax liability by 20% of the cost of your finance charges.
Right, so that sounds a little bit like gibberish to me.
I know.
So why don't we do a little example? So I think what you're telling me is that if I have £100 rental income and I pay £100 interest, then in the past I made no profit, so I paid no tax. Whereas now with your tax reducer, I've still got my rental income of £100, and let's say that it's taxed at the highest possible rate, so that's 45%. So now I have no deduction from my interest against my rental profit, and I have a tax liability of £45. And then separately to that, I get my tax reducer at 20% on my interest. So in the real world, I had £100 net income coming in and £100 rent interest going out, so no net profit. But in the tax world, I had a tax liability of £45 and a tax reduction of 20. So I've got to find £25 cash to pay the tax. Right. I mean, this is a genuinely big problem for buy-to-let owners. And I think especially because for a lot of them, the whole investment strategy worked on the basis that you got rental income in that was sufficient to cover your costs, but you were really expecting to make money on the capital value of the property increasing over time. So the idea was you paid down your mortgage over time and you ended up with a valuable asset, and you weren't really looking to make income out of it because the rental income was enough to pay your expenses and your mortgage and stuff. So that all looks pretty clear then. So if you own a rental property personally and you're paying interest, you really should incorporate.
Hang on a second, hold your horses. You haven't let me answer the second part of the question yet. But before I do, I need to ask you a couple of questions. So, what do you use your rental income for? And when do you think you will actually sell your buy-to-let property?
I think for most of my clients, rental properties are a long-term hold. And as I've said, I think the majority of my clients who've got rental property are really thinking about the rent as being something that covers their expenses. So the rental income is basically, I think, used to cover costs, and the plan is to sell the property sort of sometime down the road, almost like a sort of a pension fund, maybe.
Okay, so I think it would be fair to say that many of your clients are sitting on buy-to-let properties which have increased in value since they first bought them.
Yeah.
And so they're sitting on nice, big, juicy capital gains.
I certainly, that's going to be the case for quite a lot of them, I agree.
So when they transfer their buy-to-let property to a company, what they are doing is actually making a disposal for capital gains tax purposes. So if they are sitting on these big gains, they will have a correspondingly big CGT liability. Also, don't forget that a transfer to a company is deemed to take place at market value, irrespective of whether you actually achieve a market value price, meaning that stamp duty land tax is going to be payable. Now, do remember, of course, that at the moment we've got the SDLT holiday, which will reduce any SDLT due. But in general terms, stamp duty land tax is going to be payable as well. So not looking quite so clever now, is it?
Well, you say that, but I've read the internet, and the internet says that all I need to do to make the rental business into a partnership and incorporate the partnership, and that will then give me release from CGT and SDLT. So no.
Oh, Andrew, you can't believe everything you read on the internet. I mean, it is true to say that a partnership can incorporate in the way that you suggest, and that can be tax neutral. But for there to be a partnership, there has to be a business, and a business is something very different to simply holding properties and as an investment. And therefore, in the context of buy-to-let owners, most will just fail at that first hurdle. HMRC would also expect you to be managing the properties as a full-time activity in order to qualify as a partnership. So even if you have got a partnership, you would need to operate it genuinely for a meaningful amount of time before incorporating it. And again, if you don't, HMRC will simply come back to you and say, well, hang on a second, all you're trying to do here is avoid tax artificially, and they will look through the whole thing. The final point on this is assuming you can incorporate, or perhaps you're new to the market, it still only makes sense to incorporate if you don't need to take the money out of the business in the foreseeable future. So remember, the company will pay corporation tax at 19%, so it has net income which it can distribute as a dividend. But you as the shareholder will then pay income tax on the receipt of your dividend. In other words, your rental income is now subject to corporation tax and then dividend tax when it reaches your hands personally, which combined would generally mean overall a higher rate of taxes paid on the rental income than if you actually held the property personally.
You're really killing my vibe with all this, Rachel. Although I suppose I have to admit, yes, you're right. I guess the only thing I would add to that is that if you've lent money to the company in the first place, you can get those loan repayments out tax-free. But it's obviously true beyond that, companies make sense if you want to keep the money in there. So I guess what we've got is if I was buying a new property so that I could buy it from within the company in the first place, then I don't have your CGT issues.
Yep.
The SDLT will depend on the stamp duty holiday and all that sort of stuff. And if I've lent money into the company, then I can then get that as repayments if I need it. But if I've got my clients who've already got their property portfolios, it's sounding not quite as easy and obvious as I thought it was.
And I think, that's a really good summary. And like with anything of this nature, if you've got something already, you've got it existing, moving it into a different structure, you've just got to consider not only the immediate costs, but also what else might happen in the future, like on how do you extract the profits.
Well, that's a bit of a downer to end on. So I'm going to end on an upper instead, because I'm going to give you a recommendation for a podcast. I want to recommend that you listen to Waldy and Bendy's Adventures in Art.
Okay.
Which is Waldemar Januszek, who is a TV art critic and the art critic for the Daily Telegraph, and Bendor Grosvenor, who is also a TV art critic and what they call a connoisseur, an expert in identifying paintings, basically. And they are very, very different. Waldy is very sort of bouncy and rotund and enthusiastic, and Bendy is very aristocratic and measured, and they bounce off each other fantastically. It's a very light-hearted podcast, but it's really interested for anybody who has a sort of a vague interest in art but doesn't feel they know too much about it. They cover all periods, they cover all sorts of things. They've just been doing a review about the worst films about art, for example, and for Mother's Day, the best 5 paintings with mothers in them. So they don't take themselves at all seriously, but it's really interesting. It's really good fun, and it's another one on your daily walk to plug into, and who knows, you might discover an interest in the art world.
Interesting. Okay, I might give that one a go. Thanks for that. Thanks to everyone for listening. As I mentioned before, please do let us have your comments and feedback. We can be contacted on rachel.d'Souza@rsmuk.com and andrew.robbins@rsmuk.com. Bye for now.
Bye.